G'day, Ash and Trading Buddy. Sorry I can't be with you live today, but I thought I would just give you my impressions of what the week ahead might look like. But before I do that, let me do that so you can actually see me, I guess. But first up, let's have a look at last week and how that panned out. I'll just give you Aussie Swissy first up, and Aussie Swissy was a wrong read. I think I had the range wrong. I think the thing that I do most often kind of let me down. Well, I let myself down. I put a rectangle around this instead of a broadening pattern, and I thought we had a nice break and retest. Well, we did of that range. There's no question about that. It's also a slingshot candle pattern, so that's why I was enticed to take that position. Failed, of course, and hit the top of this broadening pattern, and now looks like it wants to go in the opposite direction. And the Aussie under a little bit of pressure. I can understand that. You could also point towards tomorrow's RBA statement and say, well, let's wait and see what happens there. There are quite a few options available or outcomes available if that happens, but that one no good. The other hand, we had Aussie Kiwi, and finally, took a long time, but finally we got this going in the right direction, and now looking reasonably good. Would like to see, of course, maybe a close no higher than our entry. That would be good, and we would look then to exactly what we were thinking in the first place, which is the three amigos. And if that does play out, price will get back into here, maybe retest that level, and then break through the bottom side of this range. How far that goes is always questionable, but that would be exactly what I'll be looking for. So that one's going in the right direction, pretty good. Aussie 200 is also going in the right direction for us. We chose this candle on Tuesday to trade. A little bit unusual for me, I've got to say, given it does have a red body, but it also had a very strong kick off the weekly pivot, which it did the previous week as well. And I have no reason to think that can't happen again. And if it were to set up that way, I would look to add to this position. We've already taken our first profit on both of those trades, of course, so they're pretty safe. And it looks like we might get our Aussie Swissy money back pretty quickly, which is good. So that was last week. This week, we have got one game changer bar only, and it is Kiwi Swissy. Kiwi Swissy is suggesting, I better go to the right chart, the weekly is what we're looking for, suggesting that we go long here. I'm never a fan of one bar reversals, and that's what this would be. But we also have a double bottom sitting here, so kind of confirms that bullish engulfing bar. I would, however, as always, like to see a higher low before I got interested in trading this long. It's going to depend a lot on what the market sentiment is as well. The Kiwi being a risk-on currency, the Swissy being a risk-off, and whichever way that market sentiment pans out is probably exactly what we're going to see in terms of direction that this takes. Don't like the reward to risk. You've got two levels of resistance up here that really it's got to get through. Throw in a trade line or a trend line as well, and it does look problematic for this to get long. So I'll stick with that as being a no. If you are a weekly game changer trader, then you'll trade it anyway, and that's fine because they have a pretty good record. But it's not in the right position for me to trade, so that'll be a no. I've only already got two on my watch list as far as currencies are concerned, and one of them is Euro Swissy. Euro Swissy, suggesting last week that we couldn't get through the monthly pivot and came off the highs here after the euro had a pretty good start to the week, it must be said, and sustainable, debatable, obviously. I don't really see that as being a currency that I want to jump into anytime soon. there's a case to be made that it's being sold so long, and the ECB, which of course meets on Thursday, may well indeed turn this around for a short period only, I believe. I don't think the fundamentals are there to sustain a big euro rally. So I'm not that interested in trading it long, but that's not why I'm looking at it. I'm looking at it to trade it short. And the reason for that is, well, primarily Friday's big bar, which was an answer in kind, I suppose, to the previous week. Well, Friday, Monday, Tuesday, Wednesday, very, very strong. And they are three green soldiers, if you like, which suggests that the market will continue to rally. A little bit of a retest of what that little bar, that little inside bar there was interesting on Thursday. But had you traded it, you would have got a rude shock. And that, I think, is the nature of trading the euro long at the moment. I think it's a very, very dangerous thing to do. So it won't be for me to trade long, but if we sneak back underneath that trade line, retest the trade line and or the pivots, then I think that gives me a strong case to go short, and I probably will. And that's why it's on my watch list. Very, very similar to that, of course, a little bit of a different position or structure, but a similar bar on Friday was euro yen, as you would expect. Again, the risk off currencies, euro and Swiss, yen and Swissy, may dictate this. But the ECB, of course, is the headline act for the week. And I dare say the market might just hang around a little bit until that is released on Thursday. It bears significance to look at the US dollar index. Why? Well, I kept saying this level here, or these two levels here, is where we would see price hang around until we got a news event. And certainly we got that on Friday with NFP, but it moved on Thursday, which is interesting, or somewhat interesting. And now it's gapped up this morning. The significance of that, closing above the 109, let's call it 109.24, 25 level, which was this level here, the high back in July, which really matched almost to the pip, if not to the pip. Hang on, I'll get there in a minute. This is the monthly chart. This level here, which to my mind is very significant and goes back to the turn of the century. You know, since we went into the 21st century, this currency pair has not, or sorry, this currency, the dollar, has not been able to close above that level. That's 21 years, right? So now it has on the weekly pivot. Two things that I would expect here. One is that becomes a false break of that level, or the other is, and of course I'm a massive fan of that, the other is we get a retest here. I just can't see this skyrocketing through here, but stranger things have happened. I would be certainly looking for a retest of that level. So I'm not a dollar bull right now. I'm very seldom a dollar bull, I've got to say. But right now I'm not, despite the fact that it's gapped up this morning. In fact, if I could find a good reason from a technical viewpoint to trade this short, I certainly would. And it does have the look to me of, if this is the range, the previous range that's broken, one break, two break, three breaks, three false breaks, which makes that candle tradable, except it's too big. Well, is it too big? You'll be trading it through this level, right? It's a tough one. It really is a tough one. And this will, of course, be massively influenced by the ECB statement once again. So I reckon if you've got a reason to get into the market and get safe in the market before the ECB statement, I reckon you could be on a good thing here. And I hate to say it, it could well be a euro long against the dollar. We'll see. We will see. But it kind of makes sense when I look at this chart. because that does look clearly like a false break to me of that level. Interesting that the market shot up this morning. I hate gaps in the first instance, but this one a little bit perplexing. But it looks red hot at the moment, the dollar index, you would have to say. Going back to the 2 euros, again, if you can get in the market before the statement and safe in the market before the statement, I think that would be wise. Everything else I'm looking at revolves around the indices, and again, like I have been for every week for the last however long, I don't know, looking for pullbacks to trade them short, and they're all pretty similar. The ones that I look at. Silver might be a little bit different in that it is at a strong support level, and there is that strong support level. So maybe expecting a deeper retracement on this one. Maybe back to there or there. Tough to say really, but yeah, expecting a deep retracement on silver before that goes again. Gold, as I keep saying, is really in a solid downtrend. That's the daily chart. When you look at the weekly chart, it couldn't be clearer to me. If I was a trend trader and not taking advantage of the rallies here, I'd be not doing my job. You've got I'll call it a double top. You call it what you want. Maybe it's nothing. You've certainly got a bearish engulfing bar there, which produced a lower low, then a lower high, then a lower low, then a lower high. So if this sequence is to continue, then gold continues to sell off this week. I can't see that from that levels point of view. Why now would it break through there? And again, I think it goes back to what I've been saying since yesterday. This only came out yesterday because I only noticed on the charts, is that we are really at an interesting point for gold, because this is COVID. COVID began here, and we've been above that line ever since for gold. But guess where we are right now? And if the sentiment in COVID has changed, which certainly I think it has in Australia, we seem to be just, okay, we're putting up with it, it's here, we're living with it. I think sentiment has changed. Then this may well influence this level. So let's see. Very, very interesting gold, the level that we're at currently. And that is a focus. If this breaks and retests that level, everything I've thought in the most recent past will, in my humble opinion, take place. I think we'll be on a bit of a roller coaster down. We shall see. Now, quickly through the pound breakout trade for today. Obviously, that's already passed, and if you're in it, you're in it. I've got no idea what's happened. Of course, I'm recording this well beforehand. Last week, I think Wednesday was a winner, Thursday was a winner, and Friday, there should have been no trade on Friday, because I think, let me just work that out. There's the high. Hang on, let's move these across. I've got to do this every day because it's the breakout. Sorry, it's the range between Tokyo Open and London Open. So there's the range from, which is what? The low of that is 115.32. The high is 115.59. So you've only got, what, let's call it 28 pips. So 14 pips from the high to low. So that would put it 14 pips from there. What was that level? 115.32. So it'll be 115.47. 115.47, which is there. So you were above that level when London opened. That level there, there's your stop loss. and TP115 above there, which would be 62. Sorry, I should have done this beforehand, shouldn't I? 62 is there. So you would have been taken in. Sorry, you were above. You would have been taken in here, right? And you would have got TP1 and got taken out, so it would have been a break-even trade. So pretty good week last week for that particular system. Hopefully you've managed to gather how it works and are in it today, and I'll see tomorrow how that's panned out, of course, because I'm away from the charts this afternoon. Righto, that's it for me. Ash, sorry I couldn't be with you, mate, today. Look forward to catching up with you on Thursday, when we shall be trading buddies once again. Have a great week, guys. Bye-bye for now.
Of course, not a problem. Now I've got a trade for you guys if you want to if you're interested. It is on the FTSE 100 and it is for a long. So let me bring you that. We can do that. We can do that. We can do that. Right, let me share my screen. Here we go. Right, so what I've got is a FTSE 100 long, and it's here. It's the price is here. I've already taken my my entry, but I think you guys, if you want to get in, you're going to be in a better space than I will be. You might want to wait for a signal. Now, the signal would probably come from the now. I'm not aiming for a lot here. I'm aiming for these highs up here. So I'm just after 20 pips. Now you can see down here there is the last level of defense in many respects, because that would be the low that it would need to break. And it's also a trend line here. Just a little trend line along here. Now we'll talk about why I don't think it's wise to stay in too much longer than this. You could definitely aim for the weekly pivot if you want to try and get one more area, but I really like first contact. Now this area here is really, I suppose, officially first contact. But I think that there's probably enough of a squeeze, and again I'll show you why I'm going for that particular level in more detail in a moment. But if you look at this trend line down here, that would also suggest that the market needs to break this area for us to change the shorter term trend to the downside. Now we are in a 15-minute trend to the upside. Now it doesn't quite sort of work out fully when you look at the other the other time frames, and we'll go through them, which is again why we're only aiming for a little bit. Now if you put your stops down here, in fact let's just check this 5-minute chart and see if there's a signal. You might want to wait for this to close. Yeah, that looks okay, doesn't it? You could put an entry at the top of the bar. Now if you were to do that, then you're going to be getting in around about well, it'd be 75.25 on the futures. So the difference is pretty much the same. You'd be getting around about the same price on the cash. Now, if that's the case, then you're looking at these lows. So you're looking at around about a 32-point stop loss and around about 25-point profit. Which again, if you don't like if you need 1-to-1 at least, you can push it a little bit higher. Maybe get it to this area here. Now I'm gonna go into detail why I think that this is my level. I'm not saying it's the level, but this is why it's my level, and why I'm only after a little bit here. I'm just going to take these off here. Close those down. Let's change the time frame and analyze the other charts here. You can see as this market comes down, it's trending to the downside. So we got hourly, hour over hour, it's coming down. But then we get this push. So actually, when it comes down to the hourly, we're actually in an uptrend. So that's the first thing to note, that we're in an uptrend. Now my take profit is on 48, which is at these highs here. This is the take profit line here. So if I bring in the trend line here, that would suggest a little bit further on that. And if I bring in another one in here, that leads me close to this area. As I say, I could probably push it a little bit more, but I'm not too worried about. And there's a few of them now. You can see that there's a hint of an inverted head and shoulders, possibly a cup and handle kind of pattern. But that leads us to in and around this point here. Now it's only going to be another 10 pips above where I am, which I may well adjust it a little bit actually. But I like this area. I like this area for a bit more certainty. I do think there's an extra push. I do think you could probably get 1-to-1 out of this, but as I always say, first contact is my strategy. So that's where I tend to come out. And I think that is more of a likely first contact than this in some respects, because it's a little bit further over and there is a pattern going on here. So I think first contact is going to be this trend line here, maybe the weekly pivot. And I'm just going to respect this zone here, and just maybe looks at that. I might push it up a little bit more. Looking at this, so let's go. Let's do that. Now, if I come to the if I come to the 4 hour. What I can see here is a definite trend to the downside. One massive move here would suggest that there's a little bit of support down here. So the 4 hour is definitely down, you know, in a downward spiral, and we are going against that, which means it's a much more dangerous trade, and it does mean that that really, if you're managing the money correctly, you probably don't want to go in full. You know, you don't want to go in a full 1%, because you are now battling the overall underlying market here. Now, if we bring in the daily, the daily's got some more room to come to the downside. Let's take some of these numbers away. The daily's got some more room to come to the downside, and I think that there's every chance that happens. But you know what? Looking at this, I think we probably could push that take profit a little bit more, maybe up another. Let's push it up a little bit more. Let's push up the take profit on this to that area there. That looks okay, doesn't it? Modify that. See what this looks like. Yeah, quite like that. Quite like that. So that does now mean that we've got a 1-to-1. So, but basically, whatever your entry to stop loss is going to be, just push it to 1-to-1. I will manage this in a slightly different way, but I will use this area down here as a hedge environment. So it'll be the same thing as a stop loss, but I will just manage it slightly different. So just traditionally, because you can see that I haven't got a stop loss here, but I will manage it in a slightly different way. But it's going to result in the same thing, where I will use this area as an area where I'll hedge. The only difference is that I won't allow price to come down and take me into the hedge. What I will look for is for price to plummet down, plummet down, plummet down, and then as it comes back, I will look to get into my hedge along this area. So in the same place, basically, but I'll look for a break and retest. So I'll look for it as a trade to the downside. So I'll look for the signal as a trade to the downside. So I hope that explains the idea of this. And we got any questions about that? So I'm looking for a FTSE 100 long. I'm trading it off a 15 and a 5-minute chart here. The big picture is for downside, no question. You know, so we are fighting the underlying trend here. But when we look at the 15, the 5, and the hourly, there looks like there could be a little bit of a push to the upside. So I'm basically trading the retracement. I'm not going to hold on to this market for very long at all, and I don't tend to anyway. And I'm not aiming for a lot, just a just a 30 pip push, which if you look at the FTSE 100, it's at 7,000. So a 35 pip push, 30 to 35 pip push is a 0.5% move. So just 0.5% move of the FTSE to the upside. And I think that's probably there. We're seeing oil stocks actually starting to gain a bit this morning. And if we bring that in, let's take these levels off, and we'll look at it. Actually, let me just bring them in just so I can see where that. You know, psychologically, I quite like no trade levels on my chart, because it's easier to not get distracted by it being a trade. So I'll know if it hits this area that we've made some money today, but we'll see what happens. Now let's have a look at some of the other bits and pieces. So oil is a big factor for the FTSE, and oil is also starting to push to the upside. So we've had over the weekend Russia deciding that they're going to again close the supply of gas to the European Union. Supposedly they're blaming Siemens, because they're saying that Siemens haven't provided them with updates, technical updates. Siemens is a German company, so they're saying that Germany is the problem and we can't open Nord Stream because there is a technical issue, so we're going to have to close it for maintenance, and we can't get the correct technology and the correct parts because Siemens aren't supplying it, because Siemens and the German government have put sanctions on anybody doing any deals with Russia. So it's kind of a bit of a cat and mouse right now. European Union are definitely going to get worst hurt at this particular stage because of the decision of sanctions. But I guess they're thinking, well, what else can we do? What that does is put the euro under incredible pressure. Now the euro is just starting to kind of come back up again, but it does put the euro under incredible pressure over the long to medium term. But what we also have to recognize is that we have got we've got really sort of like not a lot out of view this morning. Cation services PMI coming in at 55. Actually pretty good, from China, not really too expected. I think, we know that there's some global weakness, but the fact that we're still seeing some of those numbers hold on there is pretty positive. This is Tuesday, so we got cash rate from Australia. Really what I want to see is the 15th, so let's just go forward a little bit. This is the big one. This is actually the 8th. So for this Thursday, we've got an ECB meeting. Now, there's every chance that we get a rally into that meeting, because there is an expectation that the European Union are going to have to raise interest rates. They've got terrible, terrible problems. And this is the big issue with the euro, is that they will need to raise interest rates because inflation continues to creep higher. PPIs, I looked at the PPI, 34%. I mean, we're talking about numbers that are astronomically higher than they have pretty much ever been in history. And I'll show you that if I can. Look at this on the PPIs. It's just it's a crazy number. Let's change this to Europe. And we can have a look at the euro here. Look, PMIs under 50. So the 50 is the key number here. Flash PMIs from Germany under 50. Services PMI under 50. And if we bring up the chart here, you can see that this is genuinely weak. It tends to be above this area when there's growth. This is genuinely weak and weakening. from Germany, and Germany is the kind of key economy really for the European Union. Flash PMIs from the Eurozone, generally speaking, have been weaker here, but they're just above 50 there on the services. So there's other countries that are dragging it up and will keep coming down. A little bit of lack of supply with the money, which is interesting. You know, they are bringing money out of the system. Now look at this. This is where it starts to get really ugly. CPI flash estimate year on year, 9%. So it's not so much as the 9%, it's the fact that it's higher than previously, another 0.2% points higher. Core CPI, 4.3, so another 0.3% higher. So inflation continues to creep up, which pushed pressure on the ECB to raise interest rates. However, when you see that we've got PMI is weakening, it's showing us there's a weakness in the economy, and what they need is strength in the economy to raise those interest rates, and yet they can't really. Unemployment data is showing that the unemployment rate is starting to sink lower. Now, they don't really want to see that. They want to see the unemployment rate go up, and the reason that they want to see it go up is that it starts to choke the demand for goods and products, and if goods and services and products, and if that was to happen, then the labor market could go some way towards fixing the price issues. If the unemployment rate starts going up and there's a lack of supply, then the prices can start to curve and come down a bit. That's not happening, so that's not in the ECB's favor either. What else have we got? Well, that's the Monday. Now I wanted to see the PPIs. German PPI month over month is there. So let's see if we can go back a little bit further. These are the PMIs. Okay, I haven't got any German PPI here, but I can tell you that I looked at I mean, you can see. Let's just look at the German PPI as a bellwether. Look at the numbers here. I mean, it's not that the numbers are big, it's that the numbers are jumping, you know, exponentially higher. Now, PPI is to do with the producers. So this isn't consumer. So CPI is the consumer price index. This is the producer price index. Now, this means that businesses are paying more for their products. And if they pay more for their products, what then happens? They drive it to the consumer. So inflation is out of control. And the only way the ECB can start really fighting it aggressively and properly is by raising interest rates. Now, if they raise interest rates, they start to choke the economy. We've started to see that PMIs are coming down. So the economy is already struggling without them raising interest rates. So they've got a big, big decision. And I think what's likely to happen is that we get the main financing rate on Thursday. They raise interest rates. Here's the forecast going from 50 to 1.25, which is a 75 basis point rate hike, which is huge. You know, that's a big number. If you look at historically what's been happening, obviously we've been down a long way. We've been down for quite some time. But let's look at the last time they raised. From this point, 1% up to 1.25%. 1.25% up to 1.5%. So we're looking at 25 basis point rate hikes, and yet they're talking about a 75 basis point rate hike, which is huge, as I say. Now that will put pressure on the economy, and given that, they're in a very, very difficult position. So there's a chance that the euro does rally because of them raising interest rates. But I think all that will end up doing is causing down the line, and I don't know when that's going to happen, but I think that's going to end up causing the euro to maybe come up to the monthly pivot and then dive down again. So really, we are on the short side of the euro. I think Jeff's analysis was correct. We should see some sort of rally, or we could see some sort of rally with the euro. There's every chance that that's to happen because of the anticipation of this rate rise. But I think longer term, you know, over the short to medium term, we are looking for a weaker euro. if you were to then compare, you know, if you're looking at the euro dollar as a currency pair to trade, and you then start to bring in the dollar, so what's happening in the US economy? ISM PMI above 50. Services PMI way above 50, 56.7. This is back in the start of August. Trade balance is getting slightly better, minus 84, now down to minus, now up to minus 79. The unemployment rate, definitely a bit of a problem. Still a problem. It's still strengthening, which is not good, you know. CPIs from 1.3% down now to 0%. Core CPI from 0.7 down to 0.3. So the price pressures in America are actually weakening, which is really putting them in a much better position. PPIs from 1.1 down to 0.5. University of Michigan consumer sentiment actually pretty good, 55 from 51. So the consumer's feeling pretty good now. That the result of the consumer sentiment comes in the retail sales, and we are seeing that a little bit of a dip in retail sales there. Flash services PMI, so this is before the PMIs come out, down to 44. That's not particularly good. GDP now in negative territory, not particularly good. We know from Jackson Hole that that Fed Chair Powell came out and said, look, interest rates are going to have to go higher again. ADP non-farm, actually, the employment change was weaker, so that's a bit of a positive. But again, you know, PMI is pretty good, pretty solid there. ISM manufacturing PMI in the new month, this is now September, still above the 50 mark, and actually holding firm. Average earnings coming down, that's a positive. Unemployment creeping up, that's a positive. So the United States economy is just in better shape than the European Union. The European Union is forced to raise interest rates, which is why we might see a rally in the euro, but by no means is it a strong number. Jenny, let me show you what that is. A bit confused. Okay, so German PPI at 5.3 in green color. Is this not good? No, and I'll show you why. When shows green is good for currency prices. Yes. Yes. So so let's talk about the number and the data here. The numbers and the data. And I'll bring in this. So on a in a normal environment, you know, you'd be absolutely right. And when it comes down to it, you see, the let's get rid of that. Forex Factory as a website needs to give us something general, and on a general level, the PPIs going higher should be positive. So let's talk about why it's not in this particular situation. So what we've got is, now if this is these are the prices of goods. So PPI is the producer price index. Okay, now the prices of goods go higher and higher and higher and higher. So these are effectively businesses. So that's business. In fact, let me just move this over a little bit. Make that chart a little bit smaller. Good. So that's business. Now over here, what do these are consumers. So now the consumer prices are going like this as well. Now, what do you think businesses are going to do if they're paying higher prices? Do you think they will or won't pass those prices on to the consumer? Now, the reason that they're paying more is that the cost of shipping has gone up. So Russia closed off the energy source. So it means that they can't get goods. So one of the reasons is that there's been a supply chain issue. That was the first thing. Then Russia closed off the energy source. So they're now having to pay more for oil, which means that they're paying more to get the goods transported into Europe and wherever else. So when they make their goods, they've got to put that cost onto their margins. So for them to continue to make margins, they've got to pass that on to the consumer. Now, if they don't do that, they don't make the margins, people don't buy the stock. So the businesses will are kind of relating to the stock. So they won't buy the stock. So consumers are paying more and more and more and more, but they are getting more and more and more squeezed. So what then ends up happening is the consumer does start to start to get choked. So even though they are paying more for prices, the actual activity in the economy starts to come down. So what we are now seeing, the result in this is making GDP, which is the gross domestic product. So what they are making start to creep down. Now, the way that the ECB can fight higher prices is by inflating the price of the currency. And the way they do that is by raising interest rates. So if the currency right now, if €1 is to buy half a basket of goods, because the prices are going so high, half of the goods, what they will need to do is raise the interest rate on the currency, which raises it to now now €1 buys me a whole basket of goods. But what that does is it puts the cost of businesses up again. So businesses don't then go and invest. They don't go and employ more people because they've got no way to grow. The best situation and scenario for business is low interest rates because they can go and borrow cheap, and that's really when they start to grow. When the cost of the currency goes up, they start to diminish their potential for employment and all this sort of thing. So that kind of thing is absolutely fine on a base level. But what you don't want to see is before those interest rates go up, inflation pushed so high that GDP is coming down before the EU or the ECB have actually sort of acted any monetary policy. So the PPI is going higher in this instance because it's before they've raised interest rates. In this instance, is a bad thing for a GDP, and it's really when it comes down to anything that we're looking at. Let me see if I can get rid of this. So anything that we're looking at, the two things that we should always sort of like have are this. We should have GDP and interest rates. And what it should be, generally speaking, interest rates do this and GDP does that, because there's more chance for growth. But what we are currently seeing is GDP doing this and interest rates still doing that. Now, what's now going to happen is interest rates will start going like that. So GDP is likely to start doing that already from a low base. That's the problem. So it's already from a low base. Now, when PPIs start going higher and CPIs start going higher, it forces the European Union to act more, but they're going to choke the economy even further. And this is where we go from recession to depression. You know, people can't afford things. They can't afford that. If they've got high borrowing costs, they're in even bigger trouble. So when we see high PPI and high CPI in this environment, it's a negative. But you're absolutely right, Jenny. On the whole, PPIs, you know, if this was a normal situation, what we would have seen is GDP doing this, and let's say we kind of like we had PPIs doing this as well, PPIs doing that, and interest rates were coming from a low base, and they just raised them up a little bit, then GDP might just start to slow its growth. You know, it might choke it a little bit. And that's what they tend to want to see. They've got this balance of raising interest rates while keeping this curve going higher, even though it might not go quite as high until these start to come down before this does, even if this levels off. So then they can find a sweet spot and maybe lower them down just a little bit, and see if they can make sure that they're still getting their 2% growth target, while they're getting inflation under control. So they'll dabble with the interest rate. But in this example, they can't afford to dabble. They've got to go extreme. And if they go extreme, they're going to choke things. They're going to potentially kill the economy. And if they kill the economy, then we, as I say, we don't just get a recession, we get a depression. Now, I don't know whether that will happen. What I suspect is likely is that we may well have to live with inflation for a while. And the central banks do have to stop. I know they're talking aggressive. It's a lot easier for the United States to talk aggressive because their growth isn't being choked. You know, we aren't seeing sort of, when you compare PPI, CPI to PMIs and GDP, and unemployment rates, the difference in America is not so, is a lot tighter. So they've got some room to maneuver. You know, they can raise interest rates a little bit more and see the economy weaken a little bit. But with the European Union already in a situation where the economy is weak, really weak, they can't really afford to raise interest rates, which is why they held on longer than everybody else. What they were hoping was inflation would sort itself out without their intervention. They don't want to intervene, but they've got to intervene, knowing that what they're really doing is leading the European Union and the Eurozone into further hardship, which makes the euro an incredibly weak currency, because even though it might rally off the back of an interest rate rise, what do you think they're going to do after they've raised interest rates and the economy is choked? What's their next step, Jenny, do you think? What's their tool to create growth? So remember, raising interest rates, the idea of raising interest rates is to choke a bit of growth. And CPI and PPI, really, they are associated with growth, right? Because what higher prices suggest is that the economy is doing well. The economy is doing okay. People are able to raise the price of goods in a relatively flat environment, but it's not the case this time. The price of goods have been forced up by the problems in the globe. So, have you got any idea? What do you think what do you think their tool is to encourage growth? And we got any? DK Messi there. DK? You don't know? Ah, no worries, no worries. Okay. Well, what they do to encourage growth is lower interest rates. That's what they do. They lower interest rates, encourage growth. You think about quantitative easing. What is quantitative easing? Quantitative easing is increasing the supply of money, devaluing the currency. If they devalue the currency, it enables growth. We've had no inflation. You know, inflation was dead Let's bring this in. Let's have a look at some of these inflation numbers. This will do. Core PCI, that'll do. It's to do with prices. But look. In fact, America's a bit different because it's a bit more solid. So look at the European Union's. Oh, here's the PPI. Here's the PPI. Look how much is creeping up here. But look what was going on with PPI up until this point. Nothing going on. Just months and months and months with nothing. Then it was creeping up a bit. Then months and months and months of nothing again. So all of this period, during all this period, the ECB had a interest rate at 0%. And the reason for that is to try and get some inflation, into the market, because they need that to kind of, you know, inflation is positive when it's at here's some CPIs from the European Union here. And it was up and it was down. I mean, this is month over month, so not such a good one to look at. What we want to see is year on year. Here we go. Right, now 2% is the sweet spot, but look what's been going on in the EU. Now back here, 2012, 2.5, 3%. That's just a little bit high for them. But look what tends to happen. The inflation number comes down from here. You know, these are 4% inflation is a peak. 3% inflation is a peak, and then it comes down. And there's been no inflation. When we sort of like come over here, the high here was at 2.2%. That's good. That's the sweet spot for them. But then we've had 2 years where there's been diminishing inflation. So what they do is lower interest rates to try and increase inflation, and that's because if the value of the currency comes down, then you need more currency to buy the same goods. But they are not reducing the interest rate. No, they're not. No, they're not. They're raising the interest rate. And they have to raise the interest rate to battle this, because this is an extreme 8.9%. So the reason that they lower the reason they lower the interest rate is to try and get some inflation into the market and provide growth. Okay, so growth should lead to higher prices if they've got some growth. But what's happened is that inflation kept coming down even though they were at 0. So growth was just not there. There wasn't the growth they needed to see. Because if we think about why that is, if we look at this, what was giving me my point? Oh yeah. So if the EU over here, so here's the EU over here. Here's the EU. And here is the United States. Now, if these guys are selling cars, and these guys are selling cars, okay, so they're both selling their cars. Then, if I am a customer here, and we're talking about really a business, really sort of like, you know, in the middle, and the EU have lowered the price of the euro. Okay, so the euro, so I basically, you know, let's say I am somebody from Australia. Okay, I'm an Australian business, and you know, they won't be buying cars from the EU, but it's just as an example. They can either buy from the EU or they can buy from the United States. Now, if the United States interest rate, so that the cost of their currency is at let's say 1.5%, and the cost of the EU is at the cost of the currency in the EU is at 0%. It's cheaper for me to go over to the European Union. If my currency is devaluing versus the Australian dollar, it's cheaper for me for my company to go and do business with the EU. So that's why they lower interest rates, to try and weaken their currency, to try and then provide some growth, provide sort of international customers to come into the EU and say, you know what, we're going to buy from you, because it's cheaper for us to do business with you. It could be labor. You know, I could be paying for labor. It could be cars. It could be food. It doesn't really matter what it is. I'm much more likely to go where the cost is cheaper. But the problem was that there was still somebody undercutting the EU. So even though the currency is weak, it hasn't provided the growth that they needed to get. And some of that is because of mismanagement. You know, there's lots of different reasons for it. So they're not buying goods and services from the European Union, even with a currency that is relatively weak, and even with an interest rate which is down. Keep pushing it down, try and make it weaker. It just wasn't happening. So what they really needed to see was growth coming back into the economy when they've got a cheaper currency, and that would have started to inflate the prices. That would have started to make prices go back up because the demand is there. But that hasn't happened, and it's still not happened. So now what's going to happen is the EU are going to be raising interest rates, you know, and they're going to be raising interest rates to catch up with America. So they're potentially going to 1.25%. I know America's at 2.5%, but there are other nations that are still better places to buy. So the EU raise interest rates. What does that do to growth? Now it's going to choke growth when there wasn't any growth already. So they've got this artificial bump in prices, not from growth, but from a lack of supply because of what's happening in Russia. So even though we might start to see the euro rally, that rally seems to me like it's going to be relatively artificial, because it's not because of growth. It's because the ECB have to raise interest rates. Now, of course, people will go and start buying the euro because the other reason that or one of the other reasons that you might go and start to kind of put your money in a European bank account is because if I have got let's forget the Aussie, but let's say I've got Japanese yen over here, and my bank is paying 0%, and I've got a choice now to go and change my put my money where I'm going to get paid over here at 1.25%, or I could go to 2.5%, no problem at all. I'm much more likely to go over here unless this is about to change. You know, so I could get a big bump in cash. So just for a month or so, I'm going to move my money over here, let it go up from 0.25 to 1.25, make my 1%, and then I'll move it back again. So it'd be a timing thing. So money's always on the move. Which means that a little bump in the euro until we see that cash rate come out is something that could happen. Until they announce the cash rate is something that could happen. We get a nice big bump, 1.25%. I've made my money now. Now let's go and exchange it back into dollars or whatever else to go and hold my money where I can get in 2.5%. the only reason that companies may well leave their money in the European banks is because they think that they're going to go again and again and again, and obviously sort of transaction costs mean that I'm going to leave my money there for a while. But if I don't think that they've got the ability to do it again, because they're now choking the economy to the point they're going to have to lower the interest rates just to try and get, generate some more growth, then I'm not going to leave my money there. I'm going to take it out. And this is the thing, we've got this situation where we've got this news, these headlines, these numbers, and on a normal environment, we would be able to look at what Forex Factory says and say, right, yeah, that's great, because that, they are only going to put over what is a normal environment. They're not going to put another paragraph in to say, but if this is the environment that we've got, then actually PPI is a dangerous thing. It's just one of those nuances. It's not providing us with all the detail we need for every single economic situation. But the economic situation right now is not supportive of the European Union raising interest rates. Hence, it being bad that they're doing it. It's going to be a difficult road for Europe. The United States in a totally different position. They're actually, they're relatively speaking in quite a safe place. The yen, the Japanese economy, in a better position. They're not talking about raising interest rates. They're doing what the European Union should be doing. But the difference in Japan is that they haven't got inflation that is the same problem as the ECB have got. And the reason they haven't got it as the same problem is that they haven't got a conflict with Russia. So the European Union geographically sits in a very, very difficult place. And that then leads to them economically sitting in a very, very difficult place. So it's a terrible economy. If you want to find the worst economy right now of the majors, it's the European Union. And it's no real kind of accident that the next worst is the United Kingdom. Actually, today we get the Prime Minister announced, so we might get a little bit of a boost in the pound, potentially. But again, the United Kingdom's in not particularly good shape either. Debt to GDP ratio is going way too high, over 100% now. So the pound isn't very good. So the longer term picture is for euro down, pound down. Whether this is the area to get in when we've got an interest rate announcement coming out is the question. Probably not the place to get in. We probably could do with a bit of a rally here. But if there is a rally, you watch it dump again, because there's no point in holding euros. Right, sorry for that, was a long-winded explanation. Let's have a look at the FTSE before we go. Yeah, that's still okay. I mean, what's really going on here is that we are potentially going to test these lows, but really right now, while this is going on, there's no real danger. If it comes and closes below this level, then we got some problems. But really for right now, there's no danger. What we got on the hourly, still got a higher high here, potentially the higher low. So sticky little trend going on here, but nothing to really be too concerned about at this stage. Definitely want to see that close down there. We'll have a quick look at the Nasdaq. Nasdaq's in a bit of trouble. Yeah, Nasdaq's in a bit of trouble. Let's have a look at the S&P. S&P in a bit of trouble as well. Looks like the S&P and the Nasdaq might well be on support. Yeah, the broader picture here is for potentially a little bit of support here. But really, again, these indexes, these indices aren't in. It might have a little bit lower to go here before people start maybe just buying it back up again speculatively. But in the same way that we've got currencies weakening because of central bank policy, really the indexes won't rally until the Fed, the Bank of England, the ECB, the Bank of Canada, all of them really start to at least hold interest rates. While interest rates are going up, very bad environment for indexes and indices. So indices are likely to continue to weaken, and the FTSE may well, it might actually come down. So we got to keep an eye on that, and either use our stop loss, make sure you're protected, or we'll hedge the position. Okay, I am going to wrap it there, guys. Sorry for the long-winded explanation, and I hope it made some sense. If you've got any questions, then obviously put them in the box, and I will answer them now. If not, have a great week. Oh, for gaps to fill back up, do we only be concerned on certain time frames? Yes, Jenny. Yes, that is a really good point. So the gap is a big problem in a downtrend. If you're looking for downtrends and you've got this gap, has it been filled? The things with these gaps is that if they get close, it could definitely do with being filled. Look at the, but this is a really interesting point, because with the gap is an area of resistance. So if it does, touch that gap, people have got orders here to sell this. It might well take the gap out, but yes, I'd be much more comfortable trading the gap, having the gap closed before I went short, because that gap does act as some kind of pull. It's got this magnetic pull, so you may well get in short and then find that the gap is going to get filled by a big jump to the upside. And that might well happen because of that announcement of what the ECB are going to go and do. So yeah, I would definitely let that gap be filled first. And I probably wouldn't want to trade this until after the ECB's announcement either, because it might well be, as I say, we might get some positive movement in anticipation of them saying something really, really hawkish. But what I suspect is going to happen is that the movement will go up, and then they'll come out and say, you know what, we can't really do a lot after this one. We're hoping that we don't have to move again, and then the euro starts to collapse again. But let's allow the charts to tell us what's going on, because the big problem with the euro is that it's now slightly below parity, and it's very, very much oversold. It's in all sorts of trouble down here. You are welcome. Okay, that is a wrap. I will see you guys Thursday. Enjoy your week. Thanks so much for Marlin. Thanks to you guys for being my trading buddy. Shame Jeff wasn't in with us today, but he did have an important meeting, so we'll all be back on Thursday. I don't think anybody else was in. I think Simon was in today. No. Yeah, have a great week.